Stocks are pulling back a little bit here, keeping our eyes on the market, but little change still. Joining us, John Kosar has got some charts and some thoughts. He's a chief market strategist at Asbury Research and a regular pulse that we need to take on the market. Great to have you, John.
Good to be back.
Appreciate that. So big day or hype and not so important in the grand scheme of things? What do you think?
The market thinks it's a big day, and that's really all I care about. You can see it in the way a lot of the tactical metrics that we look at are pretty round up. They're jacked up, right? They're kind of right at spots where the market could have a breakout. You could see it in the NASDAQs. They've been coiling for about 6 weeks. They're close to a breakout, but they haven't given you one yet for obvious reasons. Everyone's talking 25 or 50. Here's the Asbury 6. The Asbury 6 is currently positive. It's been positive since September the 12th. So about a week, but not strongly positive. 4 or more of these constituents in either direction are necessary for a directional signal. You can see we're 4 and 2 right now. That means that very quickly, if the market doesn't like whatever happens this afternoon, this could flip back the other way. And the other thing about the A6 is it's been blinking. And what blinking means is when the A6 starts rocking back and forth between a positive reading, which is 4 or more green, or a negative reading, which is 4 or more that are red. You've been seeing that since beginning of August. What does that mean? It means the market's not quite sure of what to make of the situation. I mean, a lot of this obviously has to do with the Fed. After today transpires, I think the next signal that we get from the A6 is going to be a lot more sticky.
Okay. I love that context about the flashing lights because that certainly resonates. It's been tough to kind of figure out whether or not the market has direction basically right now. And all that's kind of added up to us getting stuck essentially every time we get up like past 56 or so. So it seems like you're ready for a conviction move too.
I think so. The market tends to go from periods of trend to periods of indecision. Right now, we're in a period of indecision. We've had a good year, but with a lot of bumps. I think there's some people thinking, has the market gone too far too fast? We have an election coming up with very different candidates. So once this coiling resolves itself and goes back to trend, you could see it right here on the chart of the S&P 500. Look at that kind of sideways, almost triangular price activity in the SPX since the middle of July. That's indecision. The market is afraid to kind of step out into traffic and set new highs because they don't know if they'll hold, but it's not negative enough to take the old lows out that we made at the beginning of August. So you get this energy that starts to coil. And that energy is typically the springboard. You see it. I mentioned the NASDAQs. One of the charts that I brought today is in Homebuilders. Homebuilders is actually broken out of that sideways congestion, but the market is jacked up here. It's kind of coiled up, let's call it, waiting to make the next directional trend.
Your metrics for the indicator for rate of change for S&P, that's one of your indicators that hasn't flipped green yet. What would be the threshold for that, John? Is that just will breakout do it, fresh new high on closing basis, or does it need to have some certain degree of oomph to it for you to meet your standard?
There's a little bit of lag in the rate of change as the old data drops off the backside, right? If you've got a lot of volatility in the beginning of that 21-day stretch, it could be a little bit jumpy. But the A6 is 4 green now. That is positive.
Okay.
Our CPM metric, the correction protection model, that's been effectively, outside of a couple of weeks, that's been risk on since November 3 of last year. So, just sitting here and waiting for the Fed, waiting for the reaction to the Fed is really what we're doing. our stuff has been generally positive
Yeah, that's true.
for
Yeah.
the whole year, and has caught almost all of this.
Hey, let's go into some of the sectors real quick. As you mentioned, home builders, just to go to that XHB chart real fast, given that we were talking to Lennar earlier, give me your 60-second take on this group, John.
Sure. What we look for here is I want to see trend, I want to see relative outperformance, and I want to see asset flow. So you've got XHB up here. It's kind of a flat chart because there's three panels, but this is a chart pattern that we broke out of by moving through the top, this green top line here. It points to, I think, 134, I think is our target here, as long as we stay up above 119.55. Down here, you see the AUM and XHB. Well, effectively, it's been above its 21-day moving average, meaning monthly expansion since the middle of July. You can see it drifted underneath just a little bit here, but since August 19th, we have monthly expansion. Then finally down here at the bottom, we've got relative performance of XHB versus SPY. In our world here at Asbury, if it's not outperforming the S&P 500,
it ain't worth looking at.
Excited about it. This has been outperforming since July the 15th.
Wow. So I mean, it makes sense. Home builders have been super reliable, got the rate thing going for them. Seems like the technicals seem pretty great. I know you like to monitor flows. Anything stand out from that category of analysis, John, in terms of where the money's going? Does it align with the price action, or is anything there out of whack that's worth trading?
Something really interesting, two things. The first one is our SEAF model, is our sector rotation model. Yeah, I won't go into it here. We don't have the time. You go to asburyresearch.com and look up the SEAF model. It's a sector rotation model that uses the velocity of money moving around the 11 sector spiders to tell you where the money's going. And this week, the top three sectors, according to the ranking system we have for SEAF, are XLP, XLV, and XLU. They're all defensive. I don't recall seeing that before. We're knocking on the door of fresh highs, all-time highs in the S&P 500, and the money right now is going into arguably the three most defensive sectors in the S&P 500. So there's a lot of hedging against bad news or a bad reaction here. Even though the broad market's higher, you also see a lot of money going into the overseas markets. We have another model called US versus the world, and we've got 8 or 10 of the 25 that we track are outperforming the S&P 500 on a quarterly and on a monthly basis. So this just isn't, bang zoom to the moon here. There's a lot of defensive positioning happening underneath the covers.
Well, yeah, that is an important point. I'm glad you bring that up because it's an odd situation to have that type of leadership in the middle of kind of the index level risk on move. What do you have a strong belief on where the truth is? Does it lie in the sector flows, or does it lie in the kind of top line, overall optimism?
Well, the sector flows tend to lead into the relative performance on the sector level. Oftentimes is one step ahead of what you see in the S&P 500. So right now, again, we're up against all-time highs. The market is hedging that index move by being overseas, by being in these defensive sectors, and stuff like XLY and technology have been where the money is actually coming from to go to these other places. Here's the S&P 500 again. 5514 is the 50-day moving average. That's the minor trend proxy, I think, for most people. That's really where we'd have to get down underneath and stay to indicate that whatever the A6 may tell us in the upcoming days, that it's actually manifesting itself in weaker prices. And of course, a sustained move up above the July 16th high, that's a breakout. So this thing can go either way. The market is hedging its bets on the top side, for higher prices here. But my feeling is we're going to get a nice strong trend to either trade, being bullish, or to avoid if the market goes lower between here and Thanksgiving. I think we've got some fireworks over the next couple of months. We're going to get a nice trending move to either avoid on the downside and buy lower, or catch the next leg higher. We don't know what that's going to be. I think this Fed decision tonight is going to have a lot to do with that.
No more sideways action. Just what I wanted to hear. Looking for some fresh trend. John, good stuff. Thanks a lot.
Great to see you. Thanks.
John Kosar, Chief Market Strategist at Asbury Research. All right, nice, good logic, good charts.